Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here. And honestly, looking at the data today, clear is exactly what we need because things are getting incredibly messy out there.
Messy is putting it lightly. I mean, usually we look at things and there's a clear cause and effect, right?
Yeah, like earnings are good, so the stock goes up. Simple.
Exactly. But today we're diving into a tale of two really different power plays. And the cause isn't earnings or supply, it's just pure politics.
That's the theme, really. We're seeing governments trying to basically bend reality to their will.
Right. So we've got two big stories. First, up in the Arctic, where President Trump is using let's say, a heavy economic hammer to try and get a massive piece of real estate. And then we're going to pivot to China, where the stock market seems to be hallucinating. I mean, one part is tanking while the other is having the party of a lifetime.
Hallucinating is a strong word, but honestly, when you look at the numbers, it's not that far off.
We're going to break it all down. And look, you don't need a PhD in macroeconomics for this. Just stay curious. So let's start with the ice. What is going on with Greenland?
It's a story that sounds like it belongs in the 19th century, but it's happening right now. According to recent AP News reports, President Trump has issued what's being called a staged ultimatum.
A staged ultimatum. That just sounds like a polite way of saying threat.
It is absolutely a threat, and it has a very specific calendar attached.
Yeah.
The administration has said, look, if there's no cooperation on this, a 10% tariff kicks in on February 1st.
Okay, February 1st, that's just a couple weeks away. And
Yeah.
10% that's not nothing.
No. And it gets worse. If there's still no deal by June 1st, that tariff jumps to 25%.
25%. That is a massive tax.
It is.
So who exactly is getting hit here? I mean, Greenland is part of Denmark, so is this just about squeezing Copenhagen?
You'd think so, but no. The scope is way, way broader.
Right.
Reports indicate the target list includes 8 countries.
Yeah.
Yep. Denmark, of course.
Yeah.
But also Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland.
Wait a minute. So he's targeting the entire economic engine of Northern Europe, Germany, and France to buy an island from Denmark.
That's it. And that's why this is so different. Usually tariffs are about trade disputes, Your steel's too cheap.
Right, an economic reason.
This is using tariffs as a weapon for geopolitics. It's economic pain to get territory.
I want to make sure everyone really gets this. I was trying to think of an analogy. Imagine you have a wealthy neighbor. Let's call him Uncle Sam.
Okay, got it.
And he looks over and says, hey, I really want to buy your garage. And you say, no thanks, it's not for sale.
A perfectly reasonable response.
Totally. But then your neighbor says, okay, but until you sell me that garage, I'm going to charge you $50 every time you walk on the public sidewalk in front of my house.
I mean, that's...
Yeah.
In the real world, you'd call the cops. That's extortion.
Exactly. But in geopolitics, there are no cops. The sidewalk fee, the tariffs on French wine or German cars has nothing to do with the garage. It's just leverage.
That's a perfect way to put it. And
Yeah.
It really begs the question, why is the garage so important? Why is Greenland worth blowing up our trade relationship with Europe?
Yeah, is there something more here than just a cool place to build a hotel?
Oh, there is. There are 2 massive drivers here. The first one is, well, you could call it the treasure hunt.
Treasure, like pirate gold.
Even better. We're talking critical minerals and rare earths.
The stuff that makes iPhones and EV batteries work.
Precisely. The Center for Strategic and International Studies, CSIS, estimates there are about 1.5 million tons of accessible reserves there.
Right.
But here's the part that gets missed. It's not just about digging rocks out of the ground.
What do you mean?
Right now, even when the U.S. mines these minerals, we almost always have to ship them to China for processing.
So to build our own F-35s or Teslas, we're dependent on our biggest rival.
You got it. So buying Greenland isn't just about owning the dirt. It's about building a whole new supply chain, a processing ecosystem that completely cuts China out of the picture. It's a long-term play for tech independence.
Okay, that makes a lot of economic sense. What's the other driver?
Location, location, location. Pure military strategy. The Treasury Secretary, Scott Bessent, has this philosophy of peace through strength.
That's a classic Reagan line.
They're bringing it back for the Arctic, the ice is melting, new shipping lanes are opening, and Russia and China are getting very active up there.
So the U.S. wants a military fortress to keep an eye on them.
That's the idea. Make sure the Arctic doesn't become a Russian or Chinese playground.
So huge stakes. But Europe isn't just going to stand there and take it, right?
Not at all. And this is where things get really interesting. The EU has developed a new legal weapon. It's called the Anti-Coercion instrument, or ACI.
ACI sounds kind of boring.
The name is boring, but think of it as a trade bazooka.
Okay, trade bazooka, now you have my attention. How does it work?
It basically lets the EU hit back hard without getting bogged down in bureaucracy. And not just with tit-for-tat tariffs. They can block American investments or, and this is the nuclear option, they could restrict U.S. companies from the entire European market.
Whoa. So if the U.S. puts a tariff on BMWs, Europe could turn around and say to, like, a big U.S. tech company, sorry, you can't do business in Berlin anymore.
Theoretically, yes. And there's already talk of reviving a retaliation package worth around 930 billion euros.
930. That's nearly €1 trillion. That's a full-blown trade war.
It is, and that's why the markets are freaking out. They hate uncertainty. We're seeing a massive flight to safety. Gold and silver have hit record highs. People are ditching risky stuff and buying the Swiss franc, the Japanese yen.
It makes perfect sense. If your biggest allies are pointing bazookas at each other, you want your money somewhere safe.
Exactly. The key takeaway here is that tariffs aren't just about trade anymore. They've been weaponized. And when politics drives prices, normal market analysis kind of goes out the window.
Which is actually a perfect transition. Because if you think the U.S. government is distorting things in the Arctic, you have to see what the Chinese government is doing to its own stock market.
It's a different game, but it's the same principle. Government intervention just completely overriding market forces.
So let's head to Asia. Usually, Chinese stocks are just one big bucket, right? If the economy's doing well, the bucket goes up.
Right. But now we're seeing this massive split. It's being called the decoupling. You have mainland China stocks, the A-shares, soaring, hitting highs.
And then you have the Hong Kong stocks, H-shares, which are just struggling.
Right. And what's crazy is that these are often the exact same companies.
The same company, same profits, but a totally different stock price depending on where you buy it.
Exactly.
Okay, I think I have an analogy for this one too.
Let's hear it.
Imagine a huge house party. That's the mainland market. The doors are locked, the music's blasting, and the government is just handing out free drinks to keep everyone dancing.
A captive audience with an open bar. I like it.
Right. Now picture the street outside. That's Hong Kong. People on the street can hear the party, but they're stuck in a cold, miserable rainstorm.
That's a really good metaphor. And the technical reason it works so well is currency.
Okay, get into the weeds for us. Why does currency make such a big difference?
So the A-shares, inside the house party, they trade in the Chinese yuan. The government controls the yuan completely. It's a closed loop. They can just print money and pour it into the room.
Okay.
But the H-shares, out in the rain in Hong Kong, they trade in Hong Kong dollars.
And the Hong Kong dollar is tied to the U.S. dollar.
Bingo. That's the key.
Yeah.
Because it's pegged to our dollar, Hong Kong's interest rates have to follow the U.S. Federal Reserve. So when our rates are high, their rates are high.
I see. So the people in Hong Kong are feeling the chill from U.S. policy. They can't just print their way out of it because their currency is tied to ours.
Precisely. The Chinese government can't print U.S. dollars to save the Hong Kong market. So Hong Kong faces global reality while the mainland is in this artificial bubble.
So who's buying all the drinks inside this bubble? Who's keeping the party going?
Two main groups. First, and most important, is the national team.
Sounds like an Olympic squad.
It's the government, basically. State-backed funds. The data shows they're just aggressively buying stocks, especially ETFs. One fund, the China Asset Management ETF, crossed $1 trillion in assets.
1 trillion yuan. That is an insane amount of support. It's like the government is acting as a floor for the whole market.
That's exactly what it is. And that leads to the second group, the mania. Local Chinese investors see the government buying, so they feel safe.
Yep.
And they're piling in with borrowed money margin trading.
So gambling on credit?
Yep. Trading volumes hit nearly 4 trillion yuan. But here's the twist. On January 19th, the regulators actually stepped in and tightened the rules on that borrowing.
Wait, why? If they want the party to keep going, why make it harder to get drinks?
Because they want a party, not a riot. They want a manageable market. They want prices to go up, but they're terrified of a 2015-style crash where everyone gets wiped out.
So it's a carefully controlled rave. Meanwhile, outside in Hong Kong, global investors are looking at things like, well, like the Greenland tariffs we just talked about, and they're staying away.
Exactly. Foreign money is cautious.
Yeah.
They see the geopolitical risks, and they are not buying the hype.
So what's the practical takeaway for someone listening to this?
It's simple. When you hear China markets are up, you have to ask, which China? The mainland market is driven by policy and local hype. The Hong Kong market is reacting to real-world global risk.
Such a huge difference.
It really is.
Okay, let's try to tie these two huge stories together. The U.S. threatening Europe over an island, and China basically rigging its own stock market. The theme seems to be government control.
It's government intervention on a massive scale. In both stories, you have a government refusing to accept the market's verdict.
How do you mean?
Well, with Greenland, the U.S. isn't making a normal offer. They're using tariffs to try and force a geopolitical sale. They're trying to buy sovereignty with coercion.
And in China?
They're not waiting for company profits to go up. They're just using state money to force the stock prices on the screen to go up.
It's like we're moving from free markets to, I don't know, forced markets.
Geoeconomics is the polite term for it, but yeah. It's a world where politics is becoming the primary driver of value.
So why does this matter to, you listening right now? Maybe you have a 401k or a small investing account.
I think there are two big takeaways. First is safety. Remember we said gold and silver are record highs?
Yeah.
That's the smart money getting nervous. When governments start breaking the rules like this, things get volatile. A single tweet or a tariff announcement can wipe out value overnight.
So it's not just about reading a company's earnings report anymore.
No. And that's the second point. Awareness. You have to be a little bit of a political analyst now. Is the company you own caught in the middle of this Arctic fight? Is that Chinese ETF you bought in the mainland bubble or the Hong Kong reality?
The whole game has changed?
It really has.
That leaves us with a pretty provocative thought. We think of a price as something that's discovered, right? A house is worth what someone pays. A stock is worth its future profits.
That's the classic textbook definition.
But if tariffs can be used to artificially change the value of an entire country's economy to force a sale, and if a government can just print money to decide what a stock price should be, does market price even mean anything anymore?
That is the billion-dollar question, isn't it? Are we looking at real value, or are we just looking at a number on a screen that a government decided was convenient for them today?
A pretty chilling thought to mull over. Thank you so much for breaking this all down. It's a complex world, but I feel like we got a much better map now.
Anytime. Happy to help.
Don't forget to subscribe and hit that like button. We'll see you in the next deep dive.